Board on this computer. Okay, so we'll do a quick review of chapters 1 and 12, which is where the transactions start to come into play.
Yeah.
Right, so you go through these transactions of identifying, recording, and communicating. This communicating ends up being through the reports like financial statements, the income statement, the balance sheet, and the cash flow, and the owner's equity, statement of owner's equity. Recording, I'll show you how I normally do just to make sure we get that started right. Users, you'll be able to get through that okay, I think. Most of this information is reading and just understanding.
Yes.
But, so like in here, who identifying users of accounting information, right? External or internal. Well, regulator is going to be external to the company, so that's going to be external.
Yeah.
CEO is internal. A shareholder oftentimes is external to the company because they may own it, but they don't necessarily operate it day to day.
Yeah.
A marketing manager would be internal. An executive employee would be internal to the company. External auditor, external. That's a nice little catch there. A production manager is internal, as an employee. Non-executive employee, I would say that is going to be external because they're usually they're not privy to the actual day-to-day operations of the business in terms of decision making. And
Yes.
so they wouldn't necessarily be an internal user of the information. They might more than likely get that from an external source. And then you have bank lenders, which would be external. I didn't write these down, but I think they're pretty close. So that kind of walks you through very quickly my little quick analysis of each of those.
Yeah.
Right. On the key concepts, ethics. Usually ethics, this is going to be important to know for sure. These what we call the fraud triangle. So what are the factors that might lead somebody to commit fraud, whether it's opportunity, the pressure, incentive to do it, or rationalization.
Yeah.
You have some accounting principles, mainly US based on this one, but there's also some international accounting standards that are referred to. In this class, we don't go into much detail about these standards, but you do learn the general principles that mostly are all of them adhere to. Let's see. And usually these principles are right here in this area. They're based on most of these types of issues, or what do they call them? Specific principles. Revenue recognition, expense recognition. These often have to do with some form of a matching principle.
Yes.
And they don't actually say that in here yet, I don't think. But you usually try to match your revenues to expenses. So, for example, if I'm selling something, right, I can't just recognize the revenue without recognizing the associated cost to that revenue.
Yeah.
And so usually you'll find if I sell a widget, let's say I sell a bottle of shampoo. Well, it may be $20 for this bottle of shampoo, but the cost may be $5, right? And so anytime that I record something on the financial statements, I want to record both of them.
Yeah.
If I'm, what would the other thing be? If I've received a bunch of cash, let's say, but I haven't done any work, that usually is what's called an unearned revenue. So you wouldn't necessarily record it on an income statement, but you'd record it as a liability. It's work that has to be performed in the future until you can recognize that revenue. So there's some things like that you'll walk through on this to understand some of these basic principles. Okay. Let's see, accounting constraint. I'll just leave that the way it is. And let's see. Not sure. Identify the accounting principle or assumption that best reflects each situation. A painting performs services for a customer. They record the revenue this period, even though the customer is not billed until next period. Yes. So this has to do with sort of what I was talking about before. You've earned the revenue
Yeah.
in the period because you've actually performed the work.
Yes.
Just because you don't have the cash in hand doesn't mean that you wouldn't record it. That's the difference between what they call accrual accounting versus cash accounting. And almost every medium to large size business functions on an accrual-based accounting system instead of a cash-based accounting system. You'll find a lot of small businesses, though,
Yeah.
cash in the drawer is cash in hand, therefore cash in hand is your revenue, right? It's what you've taken in. But sometimes you might have some liabilities associated with that, and that's why they usually focus on accrual accounting. So you always know how much do you owe if you happen to have sold something, maybe like a warranty, for example. Just because you sell something doesn't mean that you don't have to warranty it in the future. So usually companies will set up a warranty liability, so that if they sell $100 item, they might set aside $2 of that, well, quote unquote, set aside as a liability for any warranty expenses in the future, so that you're always recognizing some sort of liability on some of these products. Okay, the revenue recognition principle there. Ming Studios purchases camera equipment for $12,000 cash. The owner thinks the equipment is worth $18,000. The equipment is recorded at $12,000. So this gets down to the cost basis of what you bought something for, not necessarily its market value. Because market value can change quite drastically, and usually for most businesses on the large side, they only record things at their original cost value, unless it's something like a security, like stocks, bonds, things of that nature, where the value does fluctuate quite a bit on a regular basis. And so they want to keep track, and it's fairly liquid. And so they want to keep track of what the current value is on the financial statements, and they'll make adjustments throughout the periods. So in this case, they're talking about the measurement principle. You measure it at its cost value, not on its market value. And then Alfonso owns Consulting LLC. Alfonso keeps personal expenses separate from LLC expenses. This is like a going concern. You'll want to keep track of things separately. And so they're talking about this as a business entity assumption. I kind of think of it as a separation of personal versus business type of a deal. Any questions on any of that?
So those kind of things, it just shows that we are being good ethic in keeping these rules, or is this the focus of this one here? So it makes sure that we have good principles to keep our accounting realistic.
That's correct. So it goes back to some of these main issues, right? Where so your accounting assumptions, for example, right? Some of it has to do with just practical accounting, so that everybody is on the same page when it comes to what they're looking at. So if I tell somebody that I'm on an accrual-based accounting system, they all know, okay, then that means you're matching revenue to expenses, for example, or that you're properly recognizing liabilities that may not, you may or may not have to, pay out for until in the future. Things of that nature. There's a common dictionary of terms and way that things are handled under an accrual system versus a cash system, for example. So once you disclose that and you let people know that's how you're doing your accounting, then there's a whole set of assumptions that go on behind that. Or in some cases, like if you're doing cash accounting, you'll know where some of the potential problems are if you're looking at a business that you want to buy it. Like, let's say you want to buy a laundromat, for example, right? And they give you their financial statements and they say it's all cash based. Well, then you have to make all sorts of assumptions about what might be a liability, what they may have recorded their assets at, so you have to do all sorts of adjustments to their disclosed financials in order to come up with what you might consider a proper value for that business.
A picture of what it is.
Yeah, yeah. So these accounting principles are generally in play for almost all businesses, and you just have to understand where they sit on some of these issues. Because even if you read through some of their documentation, like most public, well, all public accounting not public accounting, public companies, they have to disclose their assumptions in what's called a 10K, 1K.
Oh,
And
okay.
so you can read through how they recognize revenue, or what their warranty liabilities are, or what their pension liabilities are, for example. And you get very detailed information about what goes in to their financial statements.
Right. Okay.
Okay. Let's see. That is that. Let's see if we can go to the next one. Business transactions and accounting. Okay, so this is where most folks really start to have problems when we start to do transactions, because you're gonna basically classify things in one of they put it down here as 3 areas. I won't try to make it too complicated, but it is fundamentally 3 areas. One
Yeah.
is your assets, right? So that's usually something that's fairly tangible. There are some things that are intangible, but they're largely things that you can put a value to, that you own. And think of it in your personal case: you have a house, you have a car, you have a bank account, you might have a pension, right? These are forms of assets. Companies have the same thing, right? And so when we're presenting information, there's an asset
Assets. Yeah.
aspect of how they're grouped, and then you have
Yeah.
all your liabilities,
Yeah.
right? So, and companies' liabilities are very similar to a personal liability. You might have a mortgage on
Yeah.
that house, right? So you have, a house on one side, mortgage on the other side. Hopefully your house value is greater than your mortgage value, right?
Yes.
You also know that oftentimes you have, if you buy a car, the minute you walk off the lot, it's usually worth less than the amount that you owe the bank, right? So you're kind of upside down for a while until you've owned it long enough that your note, your note to the bank is less than the value of the car. So if you kind of think of it in that case, that's how the main components of your assets and liabilities are made up of.
Yeah.
And then the equity is often the difference between the two. It may be, when you start a business, you might put $1,000 in, let's say, to get it started. Well, some of that goes towards, let's say, buying, why can't I think of it? Business cards, right? You might buy business cards. That's an expense. It really doesn't become an asset. But you might buy a printer, or you might buy a computer with some of that $1,000, and that becomes an asset because it doesn't necessarily lose value too quickly, and you can spread it out over time. So usually the difference between your assets and your liabilities is your equity. And the way that ends up showing up is your assets equals liabilities plus equity, right? And so they're shown, the equity is shown on your right side, and the assets are shown on the left side. And they end up being a balance. All of your assets on one side, your liabilities and equity on the other side, and they always have to equal in total. Almost think of it as like we come to earth with nothing. The Lord blesses us with a great set of parents, for example, right? And some basic talents. Over time, if we're good stewards of what the Lord gives us, we start to build up our talents, right? And our liabilities theoretically go down. And so our equity, if you think of it in the sense of, let's just put a little Excel spreadsheet out here. On my asset side equals my liabilities plus equity. Equity being how much you really own of these assets. And so we start out in life with 0. Really. Our equity ends up coming from the Lord. I don't know. The Lord gives us some talents. He throws in some equity. He's a shareholder in our business, in our life's business. So thankfully we have some skills, talents. We'll just call it that, talents, right? And then over time, we invest some time into ourselves. We learn how to walk. We learn how to talk. We learn how to do all sorts of other things. Let's call those just skills. And we personally, Lord did this. We personally, let's see, put in, let's say 5. And so we put it in 5 here. This is us.
Yes.
Right. But our parents also did a bunch of stuff, right? We always tell our children, I brought you into this world, I take you out. You should be thankful for the things I do for you, all those things, wonderful things, right? Our parents put in a whole bunch. But oftentimes those become kind of like, you can think of those as liabilities. We owe our parents. Therefore, thou shalt respect thy parents. So let's say they put in, 50, you owe them. This is in the form of like food and clothing, all sorts of stuff. Maybe it's an asset to you over time, but largely not. Kind of comes in and goes out. Let's say it's 50 here. They put in 50, it just becomes a liability.
Yeah.
And then over time, you start to work this off, right? You provide service to your family, you do all sorts of stuff. And so hopefully you kind of work this down. Maybe in some point, you repay the favor.
Yeah.
Right. And so it becomes an asset on it's goodwill. We call this goodwill in business world, right? You're building up a brand. For example, Apple probably has tons of goodwill because of the types of work that they do. And so not only do they have a bunch of assets, but they also have, and these could be patents, patents that repay. Those are intangible assets, right? You built something that only you know how to do. And so that ends up being on your side. So, over time, we get this balancing act, right? And so if I put totals on here, I can say equals sum all of these values. Those are all my assets. These are my liabilities, equals sum of all these. And I can actually just copy this one over here. And so, did I do this right? Oh, this 50 is here and that 50 is there. They're actually kind of negative. One's a negative and one's a positive. There we go. Okay, these are negatives. These are positive. They have to equal each other out. So if they happen on the same side, we're just going to zero them out. Opposite sides, we repaid them. So this is a -5. I think we should be pretty close. There we go. Yeah, I repaid it. So I took 5 out of my assets, took 5 out of my liabilities. I added some patents, some things that I only know how to do. And that's me. Okay. So over time, then, if you look at this, the 105 equals the -5 plus the 160, right? So this is a basic personal balance sheet. Basically the same thing happens with every company in the world. Okay.
That's right.
Any questions?
I think that's pretty understanding, because I sometimes find myself a little bit stuck with trying to assign transactions to different accounts. Sometimes I find myself stuck there, but I'm trying my best to read through the whole thing, in details to get it stuck in my head. I'm not that good at things, but all I can do is just keep reading and going through the video to make sure I click and stay there.
Yeah. So this is going to be a very fundamental aspect of everything you do in the semester. You got to understand that there's assets. Those equals your liabilities plus your equity, right? So those assets come from someplace, and they usually, you're borrowing money to get an asset, or somebody is giving you money or giving you some sort of value for an asset, right? So a stockholder is going to give you, let's say, $1,000 to get to build something up. You're going to take that $1,000, you can put it into an asset. You're going to take that $1,000, you can put it into a bank account, right? Those assets are there for you to do work. And so it's always assets equals liabilities plus equity. And you'll find in the problems that you are given. They might give you assets and they might give you equity, right? So they might say something like this. You might say, let me copy this first. They might say, make this bigger, paste. Okay. They might say, oh, you got $100 in assets and you only got $20 in equity. What's your liabilities?
I think it's 80.
Exactly. Good old math, right? A plus B equals C, or A equals B plus C. So if they they'll give you two pieces of information and they'll tell you to answer the other, right? So they might say, okay, this is 200 and you got 110 here, right? So what's your equity?
It's gonna be 90.
Exactly. And if they say, oh, this is 5 and this is 20, then they're asking what's your assets?
25.
Exactly. That's the basics you're going to need to understand in chapter 1, right? Just what is the accounting equation? Okay, and that's all right here. Now there's a little bit more, detail on the equity side. And this gets into the complication I was starting to add, but I didn't want to really quickly. But equity is made up of what you contribute in capital. Like, if I put the $1,000 in to start my business, plus anything that you've earned over time, right? So I made my first sale of shampoo. Well, it cost me, I sold it for 20 bucks, but it cost me $5. So theoretically, I made $15 on that, right? That $15 goes into my retained earnings, which theoretically is in my bank account too, right? Because I paid $5 for the shampoo on one day. Let's say I sold the shampoo for 20 on the next day. I should still have $15 in my bank account. So that's what this retained earnings is, your revenues minus expenses. But let's say I took some of that $15 and said, hey, I want to pay myself. Well, I'm the owner. I really don't get a payroll or a salary. I'm just going to draw that. Those draws to owners, like stockholders and stuff, are considered what's called dividends. And unless you're paying yourself a base salary plus some sort of dividend. But usually then the retained earnings is revenue. What I sold my shampoo for at 20 bucks minus my expenses at $5, and then my dividend to myself for another $5 is what's subtracted. So I should, at the end of the day, have what was it, $10 in assets, right? Let's just work that out real quick. So bought shampoo. Okay. Actually, first I had to contribute money. Let's do this first. Sorry. And we'll cut this, cut, and we'll bring it up here. So I invested in business. And I'm going to make this a little bigger. I put let's say I put $50 in my asset account. It came from equity. Okay. Then I bought some shampoo. So theoretically, that's minus $5, right, out of my investment. And then I got minus $5 in my equity. But then I sold shampoo. So I got $20 back. And that's $20 here. Because this on this side is an expense. And this is a revenue. And this one is, let's just call it common stock. Okay. I sold myself $50 in common stock. Right. And then I gave myself a dividend to shareholder. That's me. And that's a minus 5. So minus 5 on the equity side, right? So far, I don't have any liabilities because I haven't borrowed any money. So at this point, let's say my totals, go back to my totals, equals sum of all those items, copy that over. Let's just put one here and let's put one here. So my assets equal my 0 liabilities plus equity. But let's say I wanted to expand a little bit my little shampoo business. Well, okay, I can expand my shampoo business, but I gotta buy, let's say, a bunch of shampoo from somebody, and I'm gonna have to do it on terms, right? I'm gonna pay them back in 30 days. So I bought a lot of shampoo.
Yeah.
Right. And let's say about $1,000 worth, because I'm really excited about my shampoo business. And so about $1,000 worth, but I had to do it on credit.
Yep.
So maybe I did it with a credit card, maybe I did it with the supplier of the shampoo, however it is, I still bought it on credit. Right. So now I still have my equation equals, right? 1,060 equals $1,000 in liabilities equals $60 in equity.
Mm.
So this is the most basic form of transacting. I'm just showing you a very quick and easy way of doing this. The reality is it's a little bit more difficult, but I'm just putting it in very kind of high level terms.
Oh, good.
Does that make sense?
Yeah, that makes
Yeah.
sense. Yeah, I appreciate you going to details with these. Yeah, these transactions, it's really good. It's really
Okay,
good to understand.
perfect. All right, so that's what this is going to walk you through, right?
Yeah.
And I've actually hit every single one of these: common stock, dividends, revenues, expenses. I've done some assets, I've done some liabilities, right? So with that basic understanding, they're going to walk you through the same thing in this video, right?
Yes.
How do you work through that? Now each of these accounts, okay, so let me just show you. If I go back to here, on the asset side, you'll usually have things like, and we'll just talk about accounts for now. Okay.
Yeah.
So the accounts under an asset is usually something like, let me just make this a little bit, oops, I did the wrong direction. Asset accounts are usually like cash, okay? Bank accounts might have what's called accounts receivable, meaning you sold something to somebody, but they're not going to pay you for another 30 days,
Yes.
right?
Yep.
Okay, you might have inventory. So my shampoo example, I bought $1,000 worth of inventory.
Yeah.
Actually, right now, bought shampoo, I sold it. Okay, so yeah, I only have $1,000 in inventory because whatever that first thing I bought, I sold it. Okay, I bought another, what is this? Probably 200, 200. I think it's 200. Yeah, 200 bottles of shampoo. Right, so that's all in inventory right now until I sell it. I might have equipment. Oops. Equipment in my asset accounts. I'll have, what else will I have in equipment? I won't make this complicated. I'll try to keep it straightforward. Yeah, okay, just equipment. Then you might have like patents,
Yeah.
right? Copyrights are assets, right? I might have also goodwill. That usually is, we'll just call it goodwill for now, but usually it's the difference between what you buy a business for and what their actual assets are valued. So let's say you pay $100,000 for a new business or a business, an operating business, but all the assets that you buy are only worth, let's say, $80,000. You got a stove. Let's say you've got a place, a business that's worth something, and all that totals 80,000. Well, that difference, that $20,000, is what you're paying for the brand, if you will, for their presence in the market, for their location someplace, for their customer list. There's a lot of different things that might go into that goodwill, and that goodwill is just intangible. It's something you paid over and above the value of the business. These are all assets. Okay, your liabilities are going to be something like, generally, it's going to be things like accounts payable. Okay, so this is I went to some merchant and bought $1,000 worth of shampoo, but I don't owe them for another 30 days. So that's accounts payable. It might be notes payable, right? I bought a car and I have a little note that I owe back to the bank. I have mortgages payable. I might have salaries payable. Anybody that's worked for a company, you get paid every 2 weeks, let's say, or you get paid every month, right? Well, the first day that you work, you didn't get paid. Well, most people don't. Some people do get paid on a daily basis, but most people don't. So every day that you work that you don't get paid, that becomes salaries payable. We used to call it accrued payroll, but it's money that's owed to your employees that you haven't paid them yet, right? You might have taxes payable. Whoops. You'll notice a striking resemblance to all these accounts.
Yeah, yeah.
What's the resemblance?
It's like your what's credit.
Yep,
It's like
absolutely.
for borrowers and the people you borrow from.
Yep, exactly. And you'll
What's
also know in the title of it, it usually says payable. You know,
Oh,
it's a little clue. If it says payable, it's definitely a liability almost all the time. But you might have something like unearned revenue.
yeah,
In some businesses, for example, like on construction businesses, you might charge your client a mobilization fee. That's an upfront fee to get all your equipment and all of your people on a site so that you can start working, right? Well, until you get all those people there, you really haven't earned that mobilization fee. And so what they'll do is they'll put it in a liability account. And then as you earn it, they move it from liability to your revenue, which is over here. So it's just it's a temporary holding spot.
yeah, yeah.
And what else might you have in here? Taxes, salaries, mortgage. These are the common ones. There might be some others that come up along the way, but they are all something that you owe. Oh, warranty expense or warranty liability. Okay, something like that. Something that you owe or that you are obligated to do in the future.
Yeah, yeah.
On the equity side, you're going to have generally, oops, wrong one. You're going to have things such as common stock.
Yep.
Okay. You're going to have sometimes a thing called preferred stock.
Okay.
Okay. It's very similar to common stock, except that if you ever do like dividends to your shareholders, your preferred stockholders get first right to those dividends, and usually it accumulates. Almost think of it as like a loan to some extent. The shareholder gives you the money in exchange for a commitment that the minute you give dividends out, that they're going to get, let's say, 5% on their value, guaranteed before all the other shareholders get any money. Right. So that it's a slightly different arrangement. It's called preferred stock. You'll have things called paid in capital, which you'll learn about. Paid in capital, which you'll learn about a little bit later on. I won't get into right now. You'll have retained earnings. You'll have dividends. And you'll have what other accounts in here? Something called treasury stock. I'll say something about this real quick. Treasury stock is something that you at one time sold to somebody.
Yeah.
You know, you issued some stock to Brian Lewis, and then later on you bought that stock back from Brian Lewis. Well, because it's you bought it back, it's called treasury stock. It's stock owned by the company that it originally had issued out to somebody else. So that's called treasury stock. So these are the types of accounts that you'll have in each of these areas. And when you record your transactions, just like I recorded it here, right? Invested in business. This one, let's say this would be let's say this one went into my bank account.
Yes. Yeah.
Right. And it went to common stock. I already had that here. Right.
Yeah. Bank account.
And then this one came out of my bank account and it went to an expense. Right. And let's say this is actually, let's call this, oh, I missed a couple. There's revenue and their expenses. And usually expenses have all sorts of different types: salary expenses, rent expense, utilities expense, telephone expense, salaries expense, you name it. Anything that you pay out to somebody for work that they perform for you is usually an expense. And revenue might be
income.
Yeah, anything associated with something you've sold.
Yeah.
Okay.
Always.
So those would be over here, revenue. This one sold shampoo. This one went into my bank account as well.
Yeah.
Dividend to shareholder. This came out of my bank account, and the dividend was a dividend to the dividend account. Bought shampoo. This went into inventory, and it went to let's see, this is called accounts payable. Okay, so that's how those were generally transacted in each of these different accounts.
Revenue and dividend. Yeah, I think that was something that I struggle with. It's couldn't you know, and I couldn't understand which one is, you know, the accounts to, you know, like we did like last semester, we did the cash accounts, inventories and everything like that. But
Yeah.
I think it's, yeah, over time, it's making a lot more sense to me now than before. But
Yeah.
yeah,
Think of it as like a drop down. So these are all my accounts, let's say on my asset side. So I'm going to show you a little trick here in my data. I'm going to do a little trick here. I'm going to make a list, and I'm going to call this list from right here. I'm just going to do a sample of this. So let's say every time I do a transaction, right here,
yeah,
and I have to choose which account I'm going to apply it to, right?
yes,
And these are all asset accounts. And it would be the same thing if I had, all these data validation, make this a list. These are usually, usually, these are, when I do this transaction, I only have these as liability accounts that I have to choose from, right? So but I can only choose a liability account because I bought shampoo on credit, right? So it has to be a liability account. But what'll end up happening actually is something more like this. I'll show you here real quick. What'll happen is you'll have a chart of accounts. It's called a chart of accounts because if I can get this over here. This is your chart of accounts. I'll take this one out. Okay. This is your chart of accounts. Let's see. Chart of accounts. Okay, and let's do this a little bit differently. Sorry, I'm gonna just copy this over so I don't have to do too much. I'll move this over here. Okay, so usually your chart of accounts goes something like this. All your ones, let's call this 100 is cash, 110 is bank accounts, 120 is accounts receivable, 130 is inventory, 140 is equipment, 150 is patents, 160 is copyrights, 170 is goodwill. And then all your liabilities are 200s. All right, so let's start out with accounts payable is 200, 210, 220, oops, 230, 240, 250, 260, right? And then all of your pure equity, just the equity accounts, that's all these right to about there. These would be like 300s. Okay, so let's call this 310, 320, 330, 340, 350, 360. Okay. All your revenue accounts are going to be something like a 400 account, or it could be 4,000, it could be whatever. I'm just putting these in nice little numbers. And all your expense accounts might be 500, right? So this is what is called a chart of accounts. So that when I go here, let's change this a little bit. Let's change all this. Data validation. Let's go back here. So I'm going to select all these accounts. I'm not sure if it's going to let me do this, but probably not. Yeah, I didn't think so. We'll just do data validation again.
That's so cool.
So when you go to record your transactions, you're going to have this long list of accounts, but usually they'll have a number in front of them. So you can quickly identify whether it's an asset, a liability, an equity, a pure equity account versus a revenue and expense account. Okay, but this is your chart of accounts. Does that make sense?
It
Or
makes
help?
sense. Yes,
Okay.
it's sorry.
Okay, so then you'll find that your revenue and expenses are in your income statement. Your statement of retained earnings is just your retained earnings issues, which is net income, which comes from your income statement, minus dividends, which is a component of retained earnings, excuse me, equity. Your balance sheet is your assets equals your liabilities plus equity. And then your statement of cash flows really is any changes to your cash flows. And this, you'll get into this in, let's see, week 3, I think. So you understand cash flows a little bit, right?
Yes,
And
yes.
this goes through the different income statement, balance sheet, how they relate to each other, right? What they look like, how they relate one to another, how they flow, how the information flows from one place to the other. Which is very important to work through and understand. I won't do it justice by doing a quick review of it, but make sure you read through this and
Yeah,
understand what each financial statement includes.
financial statement includes.
Yeah. Yeah. So these 3, I mean, this is a good exercise to work through to see how everything flows from one to the other. Okay. And then you have some basic, what are called ratio analyses.
Yeah.
These are, this is a return on assets. So you take your net income divided by your average total assets. Let's see, can I,
Yeah, we did that last semester, I think.
yeah. So if you've worked on this already, it should be pretty straightforward, but you just have to find in the income statements what their net income is, their beginning and ending asset value, and divide it by 2 gives you, how this is a good sample of what that looks like. Usually in these problems, they'll give you the information like this, and they'll tell you compute the return on assets, right? So as long as you know how to take these pieces of information, drop them into the formula, then you'll get the right answer.
Yeah.
Okay, so this is I would say, a pretty detailed review of chapter 1 and the information that you'll need to work through next week. Any questions about that?
Oh man, I'm just grateful that I jump into to learn this, because sometimes it's a bit I go through the reading, not yet the reading, but I go through the videos to know exactly what they talk about.
Yeah.
And I think when you discuss it like this, it just, oh yeah, that's what it means. It's supposed to be like this, like that. And I think accounting, I have to really get my head around it a lot.
Yeah, you have to get in the right mindset.
Yeah.
And because it's really just about organizing information. And then in some cases like this one, how to calculate certain pieces of information. But once you understand the organization part, primarily assets, liabilities, equity, account structure, you'll have a really good start on how things flow, especially when then you figure out, okay, the balance sheet is focused on one piece of information, income statement is focused on another piece of information, statement of retained earnings is focused on another piece of information, right? You just have to then figure out how they all come together.
Yeah.
Okay. I think that's probably about as much damage as I can do in one study. And I don't even have to go over those. I think I've probably covered most of this pretty well.
Yes, yes.
Okay.
Oh, thank you.
You bet. Any other questions that come up, just let me know. Be happy to answer them.
I put myself up for week 2 for the presentation. I just
Oh,
wanted
good
to
for you.
get over it and done it and get out of it.
That's right.
See how it goes.
Yeah. That is the way it goes. It's pretty good.
Yes. Well, thank you so much for helping me today.
Yes, thank you.
I just have to do a lot of babysitting after this.